Hi, it's Wes Burke with Central Coast Lending. I put together this mortgage market update at least once a week to help break down what's actually happening out there. There's a lot of noise in our industry right now: rates, bond market movement, inflation data. It can be tough to connect all the dots on what really matters, especially if you're out there trying to run a business or serve clients at a high level. My goal with this is simple: give you a clear, honest read on the market, what's driving it, and what it means for you as a loan officer or independent mortgage professional. So, with that, let's get into today's update.
Headline for today. Rates are holding in a tight range. The bond market is searching for direction, and uncertainty around inflation and Fed timing continues to keep mortgage professionals in a defensive but opportunity rich position. We're in one of those markets where nothing is dramatically breaking, but everything still matters. Let's start with the big picture. Mortgage rates have been relatively stable over the past couple of sessions. We're not seeing big swings, but we're also not seeing meaningful improvement. That tells us the market is still waiting on clearer signals. The 10-year Treasury continues to trade in a narrow band, and that's really the story. The bond market is stuck between two competing forces: slowing economic momentum and persistent inflation concerns. And until one of those clearly wins out, rates are likely to stay range bound. From what we're seeing, the market is still pricing in the possibility of rate cuts later this year, but those expectations continue to get pushed out. That's been the pattern for months now. From a daily market perspective, the tone remains cautious. There's continued focus on inflation data, not just headline numbers, but the underlying components. Shelter costs, services inflation, and wage growth are still keeping the Federal Reserve from getting comfortable. At the same time, there are signs of economic cooling. We're seeing pockets of softer data in manufacturing, some moderation in consumer spending, and a labor market that, while still strong, is no longer accelerating. So, what does that mean? It means we're in a transition phase, not a crisis, not a boom, a transition. One of the biggest questions I get right now is, if the economy is slowing, why aren't rates coming down faster? Here's the reality: the bond market doesn't just care about growth, it cares about inflation and risk. Right now, inflation is still above target. Government debt issuance remains elevated, and global demand for US Treasuries is not as strong as it once was. That combination is putting a floor under rates. So even when we get weaker economic data, rates don't rally as aggressively as they might have in previous cycles. That's important for all of us to understand and to communicate clearly to our clients. There's also a consistent theme emerging across industry voices. Capacity remains an issue. We still have too many loan officers chasing too few transactions. That hasn't fully corrected yet. But here's the shift: the professionals who are adapting, those who are investing in systems, relationships, and consistency, they're gaining market share right now. This is not a volume driven market. This is a strategy driven market. Let's bring this down to the practical level. If you're a loan officer, here's what matters right now. First, rate stability is an opportunity. When rates aren't volatile, you can have better conversations with clients. There's less fear, less urgency, and more room to educate. Use that. Second, purchase business is still the core. Refis will come back, but not at scale yet. Right now, it's about purchase transactions, realtor relationships, and first time buyer education. That's where consistency is built. Third, speed and certainty win deals. In a tight market, the loan officer who can close clean and on time has a major advantage. That's not new, but it matters more now than it has in years. One thing that stood out to me recently is how much the market is recalibrating expectations. Over the past year, we've gone from rates will drop quickly to rates will stay higher for longer, and now we're somewhere in between. The reality is, we're likely heading into a more normalized rate environment, not the ultra low rates of 2020 and 2021, but also not the extreme volatility we saw during the rapid hiking cycle. That normalization is actually healthy for the industry. This kind of market is where separation happens, not overnight, but steadily. The loan officers who stay consistent, continue building relationships, and invest in their process are the ones who come out of this cycle stronger. And the ones who sit back and wait for rates to drop, they're going to find themselves behind when volume returns. We also can't ignore the role of technology right now. Large lenders are using advanced AI, predictive analytics, and massive data sets to optimize pricing and lead flow. That's real. But here's the opportunity for independent lenders. We don't need to outscale them. We need to out execute them. That means faster communication, better client experience, smarter use of CRM and automation, and most importantly, being human where it matters most. Looking forward, here's what I'm watching closely. Inflation data trends over the next 60 to 90 days, any shift in Federal Reserve language, and labor market softening. If we start to see clearer disinflation, rates could move lower. But if inflation stays sticky, we may remain in this range longer than people expect. So the strategy remains the same: control what you can control.
So that's where things stand today. Look, this market isn't easy, but there's still a real opportunity for the right people with the right support and the right approach. I truly believe that independent mortgage professionals can still win in this environment, but you have to be aligned with a company that gives you the tools, the flexibility, and the support to compete. If you'd like to learn more about how Central Coast Lending supports our loan officers and helps them stay competitive in today's environment, simply give me a call. I appreciate you spending a few minutes with me today, and I'll see you on the next update.
To connect, my contact information is on the screen. I look forward to hearing from you.